Hi, everyone. My name is Scott Gevertz, and I am the Program Manager and Senior Wealth Advisor for Southland Credit Union. I appreciate you taking time out of the middle of your day to join us for this webinar. Today, we're going to be talking about preparing for retirement. If you do have questions, put them in the Q&A section. I can see them, and so can he, and we can answer them at the end. So let's get going. So this is the agenda of what we're going to talk about today. We're going to talk about why financial planning is so important. Let's first start talking about where to get started. You want to start by asking yourself these questions. When you're thinking about retirement, you're thinking about where am I going to live? What will I do? How much money will I need? How much money do I have? What kind of health ailments might I have that I have in my family health history? When you think of these questions, I'm sure a variety of other questions do come up. And so these are things to consider, to put down on paper as you start to plan, whether you're young, whether you're nearing retirement, whether you're in retirement. It's helping you understand kind of the process of where you need to be. So definitely start thinking about these type of questions as we go throughout the presentation. The first step when it comes to thinking about planning for retirement, whether you're beginning of your career or end, is making sure that you have a budget. A budget is basically a spending plan. It takes into account all the income that you expect to receive and then allocates that income to specific expenses that you expect to have. The spending plan shows you where our income goes. It's like a very basic plan. It identifies the specific expenses that we're going to face, how much we'll need to be able to meet those expenses. Our plan also can help us set limits on some of the expense items that we have. Let's say that when you finish your budget, you find that over the last few months that you spend a lot of money or hundreds of dollars going out to the movies. Without a budget, you probably wouldn't have much idea of where your money is going. But with your budget, you might see that you could watch a movie on Netflix or rent a movie from Amazon Prime and save some of the money that we spend going out. So there are a variety of ways to kind of help fine tune our budgets to make sure that we're spending appropriately. Lastly, the spending plan can help us achieve financial goals by controlling the expenses. That can result in your retirement savings lasting longer. It can help you work towards a better financial security. We're living longer, so the main goal is to make sure that we have the money to protect ourselves no matter how long we live. It's really hard to argue with the value of having a budget, but we're going to talk about some of the specific reasons why we should have one. And I would argue, not argue, but I would say the majority of people that I meet with sadly have never set one up. So if you haven't, don't worry. You're not necessarily behind the curve, but this is a great time to start looking at kind of understanding our expenses better. But we're going to talk about why a budget. Spending plan helps empower you to take control of your finances. You'll have the tools and information to decide exactly where your retirement money is going to. Instead of having your money limit what you can do, you're actually in charge of your money. So at its most basic, spending plan divides income and expenses into different categories. But in addition, the plan provides organization by automatically keeping a record of all your financial transactions. It also sets the stage for useful, simple filing systems that you can organize your bills, receipts, bank statements. And when you know exactly where you stand financially and being in control of your money, it allows you to take advantage of opportunities that come up that you might not otherwise miss. If you have a spending plan, you'll never wonder if you could afford something. You'll actually know. If I asked you, obviously we're doing this through a webinar, how much, if you guys know exactly where your money goes, some of you might know, some of you might not know. This is just a great opportunity to start the process. When your spending plan is operating, all your financial transactions automatically are organized at income tax time. If a question comes up, you won't have to dig through shoeboxes or like file reports to find the necessary information. You just think of all the time that you actually save if you know exactly where your money is going. It allows you to devote that time to things that are more important: family, living life, doing fun things, etc. Best of all, kind of the top reason for having a budget or a spending plan is that it will most almost certainly produce extra money. I can even say for myself and my wife, unnecessary expenses, once you've identified them, can be eliminated. You might not know you have a streaming service. You might not know that you have an automatic payment going to something. So savings, even small ones, accumulate over time. And so when you have this plan where you know exactly where your money is going, you can put those savings to work into areas that better protect you. And that's very, very important once you've retired or getting closer to retirement. So it's no secret that in order to have a budget, you also have to be very specific about your income and your expenses. So we're going to identify key types going forward. And just so you know, there is a workbook that we're going to provide in a follow-up email that will have all this information. So if you want to specifically put your own information down on paper, we'll have something that you can use. But let's talk more about income and expenses. We definitely want to look at where our money is actually going. Unfortunately, obviously under expenses, there's a lot more categories than there are for income. To make it easier though, when you're thinking about your expenses, you want to break them down into two main categories, fixed and variable. So what is the actual difference between fixed and variable? Fixed expenses are those that actually don't change over time. Some examples would be like a monthly mortgage payment or rent, an auto loan, life insurance, auto insurance, student loan payments, credit card payments, etc. Variable expenses are those that actually change from month to month. Some examples of them might be food, medical expenses, auto repairs, maybe telephone, utilities could change from in the amount that you actually have to pay. So we're going to look a little bit more closely at the fixed expenses that you'll need to include inside of your plan. When you're working on your list of fixed expenses, you're going to think about a few main things. Taxes that you might have to pay, property tax or quarterly estimated income tax if you have to deal with that, your mortgage or rent, the amount that you pay for water, electricity, gas, cable, etc. Insurance might include life insurance, home insurance, car insurance, and you also want to be sure to include any monthly car loans or lease payments. When we're thinking about variable expenses, some of them obviously are things that we need to spend money on, but the amounts can vary by month to month. So you'll be thinking about food, both groceries that you use at home or eating out, clothing for you and your family, furniture, appliances or repairs of things that you already own, gas, oil, or maintenance for cars, entertainment, could be movies, sport events, concerts, day trips, etc. And then you also don't want to forget other variable expenses. We don't typically think about this, but when we go to the doctor, we have a copayment or prescriptions, maybe it's birthday gifts or wedding presents, vacation plans. Then also we go into like the personal items, which would be like haircuts, maybe subscriptions to different streaming services, maybe it's walking around money that you keep. And so there's a variety of categories within the workbook that we'll give you. It'll break down all the categories. I also have a specific one that's a little bit more detailed that I can always provide you as well. While a lot of this is basic, most of the time we don't spend the time to put it down on paper. The minute that you do, it makes it easier to know where your money's going, where you can actually save. And so once we know what our expenses are, we want to know what our income is. So you might have, and this is, you can do this even if you're in retirement or about to plan for retirement or early on in your career. You can use this framework for all of the above. Obviously, you want to know where your income comes from. If you're in retirement or going into retirement, you're thinking about, okay, maybe I'm working part-time or I start a business. I might have annual distributions from retirement accounts. So like you have a 401k, an IRA account that you're going to have to take money out of. You could have a pension plan. You could have interest or dividends from investments that you have, whether you have stocks, whether you have bonds, whether it be money markets or CDs. And then obviously, you want to take into consideration Social Security benefits. If you take a look at last year's federal income tax return, that should help you quickly identify what your current sources of income are, and so that you can have that down on paper to know what you're bringing in versus what's going out. Then comes obviously the moment of truth, where you're looking at comparing what your income is versus your expenses. In an ideal world, we have a surplus, so there's a positive number at the bottom of that line that shows that you are saving money. What that allows you to do with the additional savings is put that money to work in other areas, whether it be in investment accounts to grow to protect you. It provides supplemental money that you can use in retirement. If for whatever reason your expenses happen to be more than your income, obviously not the most ideal situation, but then it allows you to take steps to figure out where you can reduce expenses or increase income to make sure that we turn that into a positive. Most people, once you have that down, it kind of provides some peace of mind knowing that you're going to have additional funds to help protect yourself, or at least clarity on what you need to do to make changes. The next step is determining what your net worth is. So kind of understanding first your expenses and your income and whether or not you have a surplus. Then you're looking at kind of the totality of your assets and wherever all your money is. So you want to keep in mind to concentrate only on assets in this situation, not income. So assets are any financial or material possession that has monetary value. So they include such things as cash and bank accounts, so savings, checkings, CDs, could be stocks, bonds, mutual funds, annuities, or retirement plans, life insurance policies, like the cash value, not the actual face value of it. If you have a home, what the value of your home is. If you have a car, a boat, or RV, maybe household furnishings, jewelry, books, coins, arts, those are all considered assets. They're valued at their current market value, not what you paid for them, so, or what you would hope to sell them for. It's what they're actually valued at now. And then the next thing is you want to list on paper your liabilities. So those are the financial obligations or debts that you owe to others. So they include such things as a mortgage, maybe an installment loan, if you have credit card balances, unpaid taxes or bills, other financial obligations, could be student loans, etc. Liabilities are different from expenses. They're often larger, owed to other people. A lot of times they're secured by some type of asset. For example, like our home is the collateral for a mortgage, and then your car is the collateral for your auto loan. The next step, kind of like what we did for income and expenses, is you subtract the liabilities from your total assets, and that will show you what your net worth is. Some of you might be pleasantly surprised to know how much you're worth once you do this, but why would you actually want to know this? It can be helpful to have this information when you're dealing with a lender in a situation where maybe your income isn't particularly high at the time, but you have significant assets to draw on if necessary, or if you're preparing a will or a living trust. It can be simplified when you've done your homework on where your assets are, because you'll know right away like what your assets are, what their values are, and this information is very helpful when you're planning ahead for estate taxes. Also, when you're thinking about life insurance, like how to protect family or loved ones, you might conclude when you see your net worth statement that you may not need as much protection through life insurance, or you might need more to help protect your loved ones. So the net worth can help you determine how much you need in protection for different assets, whether you have a mortgage, whether you're trying to pay for your kids' college, if God forbid something happened to you, how do you protect your loved ones? So a lot of times we'll use life insurance in that case. And then finally, your net worth is kind of just an indicator of how you're doing in terms of reaching whatever financial goals that you have. For example, as you look at if you have a 401k plan or 403b or 457 or a individual retirement account or IRA balance, you'll get a good idea of how close you are to reaching whatever goal you have, whether or not you might outlive your assets. So it kind of just gives you kind of a benchmark that you look at every year to see how you're progressing. Next, we're going to talk about a subject that's a little bit tougher to talk about, Social Security, because obviously there is some level of uncertainty with it, but I'll kind of go through Social Security benefits, how they work, so everybody understands. You can start receiving Social Security benefits anytime between age 62 and 70. 70 is like the latest you want to start taking it. 62 is the earliest that you can start taking it. The amount that you're going to actually receive will differ based on what your full retirement age is, and that's based on the year that you were born. So, for example, you'll see from this chart, any person that was born in 1948 has a full retirement age of 66. This means that you receive 100% of your benefits at that age. For someone that's born in 1960 or later, the full benefit age is 67. What we're seeing happen, it used to be 65. They've then increased the age as people are sadly living longer and we don't have enough to fund it. So they're pushing off the problem. So what you're seeing is our full retirement ages are being pushed out. So sadly, the average person takes it at 62, which means they're usually getting a reduced benefit. So the longer you can wait, the better, but we'll go a little bit more detail into it. So when you start your benefits early, anytime between age 62 and your full retirement age, there's a reduction in the amount that you're going to get. It can range between 20 and 30%. Usually it's about a 6% reduction per year that you take it early. Let's say you're born in 1950 and your benefit is $1,000 at age 66 and you choose to begin receiving at 62, you'd only receive $750 due to like a 25% reduction. In this example, if you waited to age 63, it would only be reduced by 20%, age 64 to 13%, 65, only 6%. So the closer you get, the less of a reduction that you have. Obviously, if you need income right away, taking the benefits early would be appealing. But once you turn them on, it's permanently reduced. You can't get an increase. So when you start, you can't stop it and start it again, unless you actually pay back what you already received, but typically people can't do that at that time. If you wait until after your full retirement age to start receiving your benefit, so say your full retirement benefit is age 67, you'll get an increase. For anyone born 1943 or later, you get an 8% increase per year. As you defer it up to age 70. At 70, it does not increase anymore, so that's the max age that you want to wait to take it. The longer you wait, the higher your benefit. So, and if you're technically working longer, it might increase your benefit amount because you have more years paying into Social Security, depending on how much you're making. So there's a potential to get a higher amount. It's more of a longevity play. So if someone has longevity in their family and they don't need access to it, there might be a benefit to waiting. Obviously, yeah, it has to fit into your financial plan. Someone like myself or JAG, our other financial advisor, can help meet with you and kind of understand your own particular needs and help guide you through the decision-making process. But this is a very important decision as to when to take it. The next question when it comes to Social Security is it taxed? It will be subject to federal income tax if your income is above certain limits. You can see in this example, a single person with a combined income of $30,000 would have a 50% of their benefit taxed. If the couple filing jointly with a combined income of $40,000 would have 50% of their benefit tax. So sadly, even though you paid into it, you still might have to pay taxes on some of the money that you get from Social Security, depending on what you report. Obviously, bringing in your tax consultant is a very good move to make sure that you understand the tax implications. Total income also means all sources, so it could be employment, dividends, capital gains, retirement accounts, et cetera. So it looks at everything. You can start receiving Social Security benefits while you're working. So if someone decides to still work, there's a limit to the amount that you can earn before your benefit is reduced. If you reach full retirement age, it's not reduced, but it's prior. So the limit for 2026 is $24,480. So if someone makes less than that, it will affect their benefit. If they make more than that and they're not their full retirement age, it could affect the amount that you get. The benefits reduced by $1 for every 2 of your earnings that go above the amount. Let's see. There's obviously a lot to think about when it comes to Social Security. If you're far away from it and it's not as applicable at this moment, it's still good to understand what you might receive, so it helps you plan accordingly. Whether you're 5 years out, 10 years out, 20 years out, you can still understand where my income might be. So as you save and try and protect yourself for the future, you know what income sources you may have. The easiest way to kind of know where you're at is to go to the Social Security website, www.ssa.gov. You can create an account that will show you all your information, all the amounts that you paid into Social Security, and the estimates that they would have for you at different ages. They, in the past, used to send it out to people, but now they are sending it less frequently, and so you're almost being pushed to do this yourself. It takes about 5 minutes to create an account. You put your information in, you can see it right away. I always tell people to look at it once a year to get an update to see how their Social Security benefits look. And then if you're closer, for those that are closer to the age where they might apply for Social Security benefits, there's certain items that you would want to have. You can set up an appointment with the Social Security Administration. Typically, you want to set it up about 4 months prior to wanting to actually get it, because it takes around 3 months for them to set it up for you. So there is a delay to getting it. But these are all the different information that you'd want to have. But if you have questions about that, if you're getting closer to it, feel free to reach out and we can kind of walk you through it more. This is kind of the $1 million question, or potentially more, of how much will you need in retirement. The younger you are, obviously, the more we'll need based on inflation. But when you're looking at how financial experts like myself typically gauge it, there is a general rule of thumb. However, you want to tailor it specifically to you. So like the general rule of thumb is someone needs roughly around 75% to maybe 90% of your current annual income to live comfortably in retirement. So if you figure out what you have, times it by 0.75 or 0.9, and that gives you an idea of what you're going to need in income to cover yourself. How much will Social Security contribute to that? For the average person, when you're looking at Social Security nowadays, it may replace about 30% of your total income need. It's getting lesser and lesser over time as we potentially need more and more to live. So in the past, it used to be 30 to 40, or it used to be over 40%. Now it's roughly 30%. So get an idea of what you need. So if you know that you need $8,000 to live and you're getting $3,000 from social, you have a $5,000 shortfall. That will need to be made up from the money that you save in 401ks or other investments. So it gives you a general idea of what you might need. This is kind of a breakdown of income during retirement, the different ways that people are potentially getting money for retirement. Social Security tends to average around 30 to 40%. Some people have pensions, some people don't. Some are coming from their own assets or their own earnings. So understanding where you're going to get your income is very important to help protect yourself. Something that a lot of people don't think about, but we now are seeing it when you go to the grocery store, when you go get gas, when you travel, things get more expensive over time. That's inflation. It's just the rate at which prices of goods and services goes up, and that means your purchasing power, what you can spend, goes down. And so unfortunately in retirement, you're living mainly on a fixed income for a lot of people, and so the cost of certain things continue to go up. So if you lose the ability to spend based on costs going up, it can actually affect your ability to protect yourself. So we always want to take into consideration kind of the cost of items that we have over time. I'm not sure why they do Florida. I'm assuming because it's a retirement area, so this is probably why they're showing it. But the average cost today of a house there versus in 10 years, what it could be. In general rule of thumb is roughly around 3% is the average rise in inflation. But a lot of times for retirement, things that we spend in retirement, it can be higher, between 5 and 7, for whether it be medical, whether it be for just things that we spend our money on more in retirement, it tends to go up a little bit more. So we need our money to grow to help protect what we're spending money on in the future. We also are living longer. So the average 65-year-old can expect to live to at least 82. The average 65-year-old female to 85. When you have a married couple, it's very likely to have one of the one live to over 90 years old. So a lot of times when we're creating these financial plans for our members, we're planning for 20 to 30 years in retirement. Obviously, health advancements are helping. We're living longer, but we're not working always longer than what we used to. So planning accordingly is very important. We're going to talk a little bit about medical expenses, just so someone understands what they could plan for when they're in retirement. But obviously, through our career, we're spending a lot of money for medical, whether it be our monthly premiums versus our co-pays for different medical. But in retirement, a 65-year-old American couple in 2026 will need approximately $345,000 to pay for medical expenses throughout retirement. And that does not include if someone has long-term care needs or some type of health ailment that requires additional support. So obviously, that is a good amount of money that we'll need to help protect ourselves. When you are, let me see if I go this. When you are age 65, you're eligible for Medicare. A lot of times when you're working, you're through your employer plan, but once you hit 65, you're eligible for Medicare. If you're receiving Social Security benefits before age 65, you'll automatically receive a Medicare identification card in the mail right before your 65th birthday. If you're not collecting them before 65, you need to enroll for Medicare about 3 months before you turn 65. Just because you're eligible for it doesn't mean that you should enroll or pay the premiums right away. Say, for example, someone's still working and their employer plan offers adequate coverage. You can save money by not enrolling until you retire. But an extremely important part about Medicare is that you must pay close attention to the application deadlines and rules related to applying for the benefits. If you, for whatever reason, enroll late or drop out and enroll later again, you may have to pay higher premiums for the same benefits. So definitely if someone is not covered through their employer plan and or retires, it's very important to make sure that you apply for Medicare correctly. We have a Medicare specialist at Southland that partners with us that can help you navigate that landscape. Also, myself or Jag can also help you understand better. We're going to kind of briefly talk about Medicare. I know this may not apply to everybody, but it's good to know kind of where medical care coverage goes to once you are in that space. Very quickly, I'll talk about Medicare and how it works. There's Part A, B, C, and D. Part A covers like hospitals, inpatient rehabilitation, skilled nursing facilities. It covers hospice care and some in-home care services. Part B covers any medically necessary services like physicians, outpatient care, some preventative services. As in Part A, you select your doctors and the other providers for A and B. Part C is Medicare Advantage, involves private insurance like HMOs or PPOs that provide hospital medical insurance under Part A and B. In most of these plans, you need to use the plan's doctors, hospitals, and other providers. And then Part D is for prescription drugs. If you want to have this coverage, you choose it from the private companies approved by Medicare. Most Medicare Advantage plans also include some type of drug coverage. It's a little nuanced and complicated, which is why I always highly recommend bringing in a Medicare specialist if you're getting close to it. Some people also look into Medigap policies, which cover if anything that might not be covered by Medicare, and they're offered by private insurance. And so a lot of these are things that you explore just to make sure when you're getting closer. These are things to think about. One of the largest expenses in retirement is Medicare, medical coverage, and making sure that you have proper care so that, God forbid, something does happen, you're not using your hard-earned money that's meant for daily living for medical expenses. So something definitely to consider. I won't go into too much detail about this, but some of this will talk about like the premiums, what you're paying for the amount. So it could range from usually for Part A it's 0, for Part B it could be $200 to $689 a month. Part C varies by plan, Part D varies by plan. These are all things to consider to understand what your monthly expense might be for medical coverage. There's a lot of information on the website, medicare.gov, but if you are at that age and or you're in retirement or getting closer to the age where you need it, talk to our specialists. They're great. I've spoken to them before just to understand how they walk our members through the process, and they're very detail-oriented. They'll help make sure that you're taken care of. And then if someone needs like additional coverage to cover potentially shortfalls with Medicare, because it doesn't cover everything, Medigap, these are resources that people use to kind of look into that. But I won't go too much into detail on that. But feel free, if you have questions, feel free to take a look at that. We're going to talk briefly about long-term care. It's the least fun topic to talk about, but as we age, about 70% of people need some type of long-term care or some type of health support as they age. And so it's important to understand how you can protect that. Some people have to self-fund, meaning they use their hard-earned money to cover any costs. The average cost of a nursing home nationally is about $100,000. In California, it's over $100,000. The average person needs some type of long-term care need for potentially up to 3 years. So as you can tell, if you have a husband and wife and someone needs care, it could potentially cost hundreds of thousands of dollars, which could then potentially negatively affect the other spouse if they're still alive and well. And so there are ways, different investment vehicles that could be set up when someone's younger that could potentially create a long-term care support so that you don't have to tap into your hard-earned money when you're in retirement. This is a website that you can take a look at that gives information, but financial professionals like myself or JAG, our other advisor that covers the Long Beach market, can also be of great resource to you as well. Obviously, we're talking in more generalities today to give you some information about like why you should plan. Most people over age 65 will need some type of help. Most people, once you retire, are on a fixed amount to make sure that we're set up correctly in advance so that we don't outlive our assets is very important. That's why what we're going to send you in a follow-up email will be getting prepared for retirement, where it will walk you through everything. It'll allow you to put all your numbers down on paper for yourself. A lot of times what I like people to do is to get it down on paper so that you see where your money is, what you have saved, understand what your goals are when you plan to retire. And what's so great about this is it allows you to bring it to a financial professional like myself that can put together a comprehensive financial plan for you to make sure that you're on track. Doesn't matter if you're 20, doesn't matter if you're 30, 40, 50, 60. It's always good to start planning ahead for any financial need that you may have, whether it's retirement, whether it's funding your kids' college, whether it be buying a home. These type of documents help you understand where your money is, where it's going. There's a variety of other ones. This is kind of information about retirement planning specifically. Once you hit certain ages, the government wants to give you opportunities to save more inside of your retirement account. So at age 50, You're able to put additional funds into IRA accounts or your 401k or your employer plans. Once you're hit age 59 and a half, you're able to take money out of your retirement accounts without any penalties on taking it early. If you take money out prior to age 59 and a half, unless it meets certain requirements, whether it be a first home purchase, whether you be disabled or die, there is a potential early withdrawal penalty of up to 10%. And then age 62 is the first age at which you can start receiving Social Security benefits. 65, you're eligible for Medicare coverage. 67, as of now, is the full retirement age for most people. And then age 73 is the year that you're required to start taking out a certain amount of money from your retirement plans if they are traditional, so meaning a traditional 401k, 403b, 457, or a traditional IRA, or even a SEP IRA, that you're required to start taking out money at 73. It's usually a certain percentage, and it goes up over time. The government is nice. They give you tax benefits when you're putting money into it, but they want to get their taxes eventually. And so once you hit that age, for the rest of the time, you'll have to take money out and be subject to taxes on the money that you take out. I won't go too much over the worksheet, but this will just kind of show some of the information, what you have in today's money. They'll look at your assets. So you, your spouse, the total amount that you have. It'll factor in growth rates for 10 years from now. If you want to go that far out, I would recommend using us though for these type of calculations. What type of savings that you can do from now till then to help protect yourself better. Your monthly income that you might have over your retirement. So what Social Security or retirement savings, if you have other assets, other incomes that you might get. The worksheet will have all the different types of expenses that you might have, so you can put it down on paper so that you know where your money's going towards. I'll show all of these, what the expenses are now, what they might be 10 years from now. And then assuming different inflation, like how it might be affected. And then any additional needs that you might need, how and where you put your money. So a lot of this stuff, the most part, if you want to do it yourself, you can go that deep a dive. But for the most part, when you're meeting with a financial advisor and they're doing a complimentary financial review for you, you need to know what your income is, what your expenses are, where your assets are, and then they can do the rest for you. So a lot of this goes a little bit deeper if you want to do it yourself, but some of it you can do with us that can help you out. There are a variety of different resources, apps that people use to track their expenses. These are some of the tools that are available that someone can look at to understand what's out there. Highly recommend going to the Social Security website. Some of the financial calculators are decent, and they'll just provide additional information. But if you're looking to have a more specific plan to you, definitely reach out to us. This is kind of our contact information and kind of where we cover, but our job is to help you plan for your financial futures, and so help you understand what you're doing, if you're on track, and if you're not, how to help get you there. A lot of people are not taught about how to manage their finances. They're not taught about how to invest their money. They don't know what vehicle is correct. They don't understand stocks, bonds, mutual funds, annuities, index funds, etc. Our job is to help you understand your finances and then help you tailor investments to meet those goals. If you need us to manage it for you, we can. If you just want a second opinion, we can provide a second opinion. A lot of what we also like to do is educate, like what we're doing today, is to give you some general information about a topic to see how it might be of service to you. And then if you want to do a deeper dive, let us know. And then that is the majority of the presentation. I have a few things that I'm going to show you in addition to that, but want to see and open up to any questions that you might have. So I want to get to the Zoom link. So if you have any questions about
there's a couple in the Q&A here, Scott. Do you want me to read those to you, and then one in the chat as well?
Yeah, let me see if I can get to the link myself, but give me 1 second. If you want to read off the one, that's fine. You can read them off.
Yeah,
That's
sure.
great.
So we have one. I think that this is going to be sent afterward, but Sudria Andrews asks if there's a hard copy of the booklet.
So there will be a email sent out that you could download the document and print it out for yourself. We have them inside our branches that we could give to you, but if you want, it'll be a PDF version in the email that you can download and print out for yourself, or save on your computer.
And then also Sudria Andrews asks, what if you don't have enough points for SSI?
So then you're looking at what your other income is going to be. Either you would have to, so there's different scenarios. So it depends on if someone is married, they potentially can get spousal Social Security. If you don't have enough points to get it yourself, potentially you're getting a pension. If not, you have to explore other options for income. So you may not be able to rely on it, or you might have to work to be able to get the points to do it. So it's just working through your own particular situation. So you would reach out to us, you would kind of walk through your own kind of goals, where you're at in your career, if you're close to retirement or if you have more time, and we would kind of help guide you through that.
Wonderful. Debbie Stein asked in the chat, and then also just now actually in Q&A, can you discuss the windfall Social Security process?
You want to understand what again?
The windfall Social Security process.
Sure. Let's see if I can pull something up to show. Let's see. So it was signed into law on January 5th, 2025, eliminating the windfall elimination provision, which had reduced Social Security benefits for people with pensions and jobs not covered by Social Security. So it impacted retired public servants, including firefighters, police officers, teachers, with some seeing up to like $600 increase in their monthly benefits. So as of July 7th, 2025, SSA completed sending over 3.1 million payments, totaling 17 billion in eligible beneficiaries' money. So let's see. So like technically, if you had your Social Security reduced by it, you should now be receiving higher monthly benefits. Those who never applied because should consider applying now because they may qualify. I would argue if you have a more specific question to you and your own ones, reach out to us because I could help guide you through the process specifically, but there are new rules and regulations to it, and so potentially you might be able to get additional funds that you weren't getting before based on the new rules.
Wonderful. We have a question from Henry. Well, first I have one from Henry, then Edmund. So Henry Sanchez asks, does your service provide trust information?
We do. So we have a living trust partner that helps set up, I'm going to pull up the document for you if I have it. Let's see. We have a partner with Southland Credit Union, that Affinity Trust, that sets up living trust for our members. And they also give a discount for members of the credit union. They set up a living trust, the pour over will, so it covers any assets that fall under that you may accumulate after the fact. They do a healthcare directive, power of attorney, and so everything is included within it. First home is included within it, and then they do additional homes. They do free consultations. What I'll do is I'll have in the follow-up email that we send out, I'll make sure that they provide that information as well. It's on our website. Let me pull it up on our website so you can see it. Let me see if you're Southland. So if you go to our website, which one up? Does it show? Is it showing our website right now for you guys?
It is. Well, yeah, it is.
Okay, perfect. If you go to our website, southlandcu.org, there it will talk about investment services, us. So if you want to ever set up an appointment with myself or our other advisor, there's a way to set up a consultation with us here. And then if you want to understand more about trust and estate planning, Affinity Trust is who we partner with. It walks kind of through the prices and how it is, a detail of what they actually include. They do a free consultation, which I love. And so you can always put your name in here and it gets sent to them, and then they'll set up an appointment with you. It's a very seamless process, but I highly recommend at least talking with them. I like to compare and contrast. What I do is manage money for our clients. And so obviously when you have money, you want to make sure it's protected. So I did a lot of research on different trust attorneys and different people to work with. And I've worked with Natalie for over a decade. It's been one of the easiest partners I've ever worked with. So if you ever have questions with that, it will provide information. If you just have questions about investments and our upcoming webinars, we have them there as well. Yeah.